Welcome to the Dividend Talk podcast, episode 47. More quarter one earnings 2021. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavor. If you are new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Hey, European DJI. It feels like forever since we spoke. I know we had last week off. How have you been?
Really good, but I know, it's really busy at the moment. I don't know how it's for you, but the start of May has been crazy for me.
Yeah, May's busy for me. It's also my birthday, start of May, so I've had a nice few days. Had a nice few days off last week. So yeah, enjoying it. I missed actually recording our podcast last Friday. It's become a routine. But I know we had an episode to catch up on, and we had Russ pre-recorded, so it was nice actually to spend a Friday with the wife and keep her happy and entertained for one weekend. But I did actually miss the podcast.
Happy wife, happy life. But I had the same. I didn't know what to do actually on the Friday evening. So, but glad that we went back to our routine again. It's lots of fun.
But we missed it. We missed a lot of earnings that week. A lot of big tech earnings. And I know Twitter was hopping mad with all these FANG stocks that just blew earnings and sales out the window. It was ridiculous. Apple, for example, I think they beat sales by 12 billion. Just think about that, 12 billion alone.
Yeah.
That's just crazy.
For me, last week as an investor has been one of the only weeks ever that I was so blown away by the earnings of these companies. And I'm investing now for, let's say, 6 years in dividend stocks, and I consider Apple and Microsoft and such dividend stocks. And what I heard last week, it was above me. It was just too much. I mean, I was really blown away, and I mentioned already also on social media, like I started listening to the Microsoft earnings call. Microsoft is the one that I pick out every quarter because I love listening to Satya Nadella. He was talking for almost 20 minutes about all the accomplishments that they did in a single quarter. And you know what I was even most impressed by? He knows this stuff as a CEO, and it was too much to just read up. He probably had some notes, but he could speak about it. Yeah. And how many CEOs do you know that understands their business so well? And his business is very diversified. I was really, really impressed with that. This tells me that the CEO is on top of it. He knows what his company is running really, really inside out.
Yeah, you can see that from him and how he's drove growth there. It's incredible. I was actually asked a question from a guy I interact with. He's from Ireland recently, and he basically asked me, like, would you not just consider buying these stocks, the Apple, Alphabet, Amazon, and Facebook? And he said, why would you bother analyzing other companies when you can just invest in these companies and you don't have to worry about a thing? I mean, he might have a point. I didn't quite say that. I find it hard to invest when valuations are so high, but you can see the logic behind it, can't you?
Yeah, but valuations are high. I mean, for me, Apple is clearly overvalued, right? Compared to how I analyze stocks. Microsoft was around fair value. Facebook is for me also around fair value. Google is a bit overvalued for me as well. But if you think about the next 2 decades, I think you will still get a proper return on those companies. But yeah, not from a dividend income point of view, let's say. And that's what we're investing for, right?
Yeah, true. And what about IBM? They're back, baby. Have you seen the
Yeah,
news?
I heard that they now are. I guess they are capable of making 2 nanometer chips now.
They've spoke about it. I don't believe that they will be making them themselves. So I think they'll
Hmm.
be using Samsung, are one partner that they'll be using. They haven't announced who, but I'm pretty sure Intel might be there as well. And this might
Yeah.
be a good way for Intel to get back into the game. I know they're lagging well behind Apple and the likes of these companies, so it might be a way for them to catch up.
Hmm.
Interesting to see from that side. I mean, 2024, they projected they might start selling these things. I don't know. I mean,
Yeah.
it's still a long way off. It's easy to say we can do it, but it's another thing putting it into practice.
Yeah, yeah, it just shows, and we know this about IBM, right? I think it's one of those companies with the most patents in the whole world.
Yeah,
Yeah, I hope that they are able to start monetizing on this. Otherwise, it's like a company, how is it? Like us having a lot of passion for blogging and such, but not monetizing anything. For us, it is more like out of passion, but for them, I think they have a need to monetize things to keep the
yeah.
dividends paid.
But hey, look, there's been a lot of excitement around IBM, and we've made some warnings about their financial engineering. But I mean, the Red Hat are obviously building on that, and now they're throwing out a kind of a bone to investors and say, hey, look, you have something to look forward to, and just keeping investors happy and keeping them on a leash for now. And
Yeah, but we did that few shows back, right? When we spoke about an example of a company in decline.
mm,
Every first quarter of the year, they're having another kind of technology that they're trying to keep investors happy with.
yeah.
Watson, blockchain, quantum computing, 2 nanometer chips. What do you think will be next year?
Oh, I don't know. I don't know.
Yeah, probably they figured out something in the cloud by then. Yeah. But having said that, what also really caught my attention this week was the amount of growth stocks like the Wall Street darlings from last year, like Teladoc, Telehealth, right? Neo, Virgin Galactic. Those stocks have done not so well in the first quarter of this year until now. I mean, I saw Virgin Galactic from its peak of $60 now to less than $20 as an example. I think Teladoc and Neo also like 25% down. And I found this really interesting because I saw on social media quite some people, like almost like mourning together about the losses they are having on paper, right?
Hmm.
And this is always what makes me remind then why I like dividend income investing, because I wouldn't have the nerves for this kind of stuff. I mean, I of course I wouldn't I would lie if I would say that I've never the feeling of am I missing out on something last year, right? When I see everyone 2x, 3x, 4x, but then when I see these declines, it's a really really great reminder for me, like why I need to keep my head cool, and because this is really not something for me. I wouldn't be able to deal with such kind of stuff.
I don't know if you've noticed the same trend that I have, but a lot of these investors on Twitter have migrated from these kind of stocks that seem to be in decline over to crypto. And crypto seems to be doing quite well at the moment, but
Yeah.
it's just a trend that I've noticed. My timeline has changed from hearing about these companies to crypto. And I mean, I'm glad I'm a dividend growth investor because I can have a clear entry point. I know when I'm going to sell. We've spoke about this before. When you get
Mhm.
involved in these companies, when do you sell? Do you have a defined period? Do you hold them forever? If you hold them forever, what do you do when they drop 40%? I mean, it's hard.
Yeah. Yeah.
Investing is hard, and anyone that tells you any different is telling you lies, because it's probably made to seem to be a little bit easier. We're in the longest bull market we've ever been in. Stocks are just going up, but they're going to go down at some point, or you're going to underperform the market at some point. So I'm just glad that I'm not exposed to them stocks. I do
Yeah.
have shares in Neo, but I'm doing a covered call strategy with Phil. Actually, me and Phil chat quite regularly on this, and Neo is one company that I own, but I mean, again, it's controlled within a covered call strategy. But long term, I wouldn't want to hold them longer than 6 months.
Yeah. Well, the only thing I can say that this year, I don't know. I checked it. I think we did it with our quarter one report, right? I was up, so it's the only thing I can say. Yeah. Cool. So maybe let's start looking into some earnings then from this week, because I think you looked into CVS Health, right? If I'm
Yeah,
correct.
yeah. CVS, they're kind of along the lines of Walgreens, and I really, really like them as a company, but I've always kind of overlooked them because not suspended, but they've kind of maintained their dividend. But looking into them a little bit more, I think they're right to maintain their dividend. Their focus is on getting their leverage ratio, so they're trying to get their debt down to under 3x, which is sensible in my mind, while maintaining the dividend. They had a really good year, a good quarter, sorry. So the healthcare was up 6.7 because the government services came in. Pharma was up, basically because of this speciality pharma revenue growth that they have and brand inflation. They were kind of hit a little bit by a poor cough and cold season, which is which is bizarre because COVID has got rid of every other sickness. But this was offset then in retail by vaccine administration and so on. So they've had a really good first quarter. Again, I think they're a little bit undervalued. They will raise their dividend again. They've stated this once they get their debt under control. So a really solid quarter, and a company that I'm liking and may want to get involved in sometime this year.
And I said, is there any threat from Amazon here or something like that as well?
I mean, Amazon threaten the whole world, don't they? And I remember when Amazon were going into this business. It's the same at Walgreens for me. CVS are not going anywhere. Amazon will try and come in, but I think CVS are pretty safe.
Super. And then I said we also looked into a German company, actually, Munich Re, and it's one of those companies that we actually did a full analysis on in one of the podcasts. So
Yeah.
let's put the link into the description as well. So if people want to listen back to it, because that's where we went more in depth into the company. What were your findings around this company, or your thoughts around the first quarter earnings?
Yeah, pretty much on par with what we expected. I think there was a cold snap in the US that kind of hit some, though they had to pay some premiums out that were unexpected. But other than that, it was quite solid. The April premiums is up 17%, which is quite good. That's a mixture of raising prices, which was about 2.5%, and then natural premium growth of people wanting to get insured. But no, overall, I'm quite happy with how they performed. COVID has had an impact on them. We know this, but we expect them to come out a little bit stronger, maybe the second half of this year. Return on investment, I think, is 2.7%. Return on equity is 10.4%, and overall, another good quarter from them.
Yeah. And what is also really nice, they paid their dividends yesterday. So yesterday I got quite a chunk of dividends from them because I own, I mean, not the biggest position, but a nice position, and they pay a dividend once a year. So I was really happy seeing the money coming in. I mean, for me, May, like now, with also German companies paying in May, and specifically like this one and some of the other companies like Bayer that I own, not really nice, juicy dividends. So very happy with Munich Re, I must say, specifically yesterday. Big smile on my face.
I don't own any shares of this company, and it really bothers me because they just seem a little bit overpriced. But I think I might just have to bite the bullet because it's dependable. We've given an opinion on insurance companies, and I think we'll see some further growth. So I might just have to bite the bullet and
Yeah, and this is, I would say, after Nestle and Unilever, probably one of the most reliable companies in Europe when it comes to dividend payments.
of course.
And their business is solid and strong enough that you could, I mean, it's always dangerous to say this, right? So full disclaimer here, but you could almost see it as a bond. Yeah, the only thing is, will you get your full coupon back at the moment you want to get out of it?
Yeah.
Yeah. Yeah.
Yeah, it's like Microsoft for me. I it took so long to bite the bullet there, and now I'm just like, you have to pay for quality, don't you? So
And did you buy any Microsoft
yeah,
lately?
I bought some this week. I bought a couple of shares, 3 or 4 shares this week. Completely forgot about it. I think I bought them Tuesday or whatever day they dipped a little bit. Buy the dip, as I say. But bought them on Tuesday. Bought 4 shares. But my average price is still 216, I think. So it's
Yeah,
not
yeah,
too
yeah.
bad. Yeah, yeah.
Interesting, because when I did my video on Sunday, you mentioned still a bit too expensive for you.
It was, and I don't know. I go through this in my head sometimes. Sometimes I feel it's too expensive, but then look at the results they have, and they're just a quality company, and you see how much, like, you put out your tweet and you have,
Mhm.
this is what moat looks like, and I was looking at that going, oh man, it's true, and so
Yeah.
I ended up buying some. It's your fault.
For me, what was also convincing with Microsoft is that their price didn't really dip. It stayed quite flat compared to other companies. Yeah.
Mm.
So for me, it was a good sign that, okay, the quality is here. The market can't even push it down if it wants to at the moment. It's just quality all over the place. But interesting. I mean, I bought 2 shares for my children as well last week, so around $250. So it's yeah, it will do well over the next 10 years. I'm sure of that.
Yeah.
Shall we do
Okay.
another pharma stock, but now big pharma?
Okay. We might look at ABBV, who blew it out of the park this quarter. I think revenue increased by 51%. Their oncology business increased 8%. We know Humira did quite well in the US. It struggled a little bit in Europe, actually, because we know that the patent is up and biosimilars come into play there. But I think another solid year. We're starting to see some of the smaller segments come up. So you have like Sky Ritzy and Rinvoq, I think they're called, that are starting to do well. Still not impacting as much as Humira. I mean, that's what, nearly 5 billion of revenue there. So it's a huge chunk. But it's nice to see. It's nice to see other segments kind of picking up, and we still are not seeing the full impact of allergen, even though Botox Cosmetics and Botox Therapeutics are starting to do well. I think they combined 1 billion between them in revenue. So a good month, a good quarter, should I say. They've been repurchasing shares as well.
Mhm.
I think they've repurchased about 550 million, which
Yeah.
is good. I still think they're quite cheap. So I like when companies buy when they're down a little bit in price. So overall, I was quite happy. How about you?
Well, generally, I think these were just solid numbers, right?
Mm.
So how I look at it on an annual basis, the annual reports are for me the most important. There's also lots of data there. So in the quarterly reports, I just want to see continuation of the trends
Yep.
that I'm expecting. And yeah, they can miss sometimes a quarter, but for me, these were just solid results. What I just wanted to mention about biosimilars, right? So I'm having also, for instance, AbbVie in my portfolio, and what I'm noticing when I also start studying other stocks a little bit with drugs that go off patent, it's really hard to produce a biosimilar by another company. So what I'm observing is that the stock market expects like a steep revenue decline as if these were becoming generics. But with biosimilars, it's all about the manufacturing as well, the quality, the safety. I've seen that it goes much slower, and therefore that the revenue decline is rather delayed. Not saying that it doesn't decline, but it's not so sharp as with generics, which I think might be the case at AbbVie as well, which in that case means probably some more billions that they can squeeze out of it than
Hmm.
if it were a simple drug. And those billions can be really, really helpful for buying back shares and such, and cleaning up the balance sheet.
That's why ABV are priced where they are, a little bit undervalued. I mean, everybody's expecting this drop in, is it 2023? So we're
Yeah.
expecting a sharp drop, and it could be the reverse. Actually, it could be we get to 23 and there is no steep drop, like you say. Investors will be happy, and we might actually see a rise at that time. So I'm not too concerned. I'm like you. we will see a drop. There's no doubt about it. We
Yeah.
will see, and we've seen that in Europe. There was an 8% drop, but it won't be as steep. I mean, these companies have agreements with doctors and pharma companies already in place, and it's hard to move. So we'll see. We'll see.
Yeah. Okay. So then on Monday, also Realty Income, one of the dividend investors' darlings, reported, and I was quite impressed by the numbers as such. I mean, I guess probably what's first most important is that a week earlier they announced a merger with VRite, which personally, look, when I looked into the facts and such, I like the merger, but I still have this feeling of the ARCP. I said debacle because I don't know if you know, but ARCP was the predecessor. It was at the time a 7 or 8% yielding real estate trust. Many people in the dividend investment community and Seeking Alpha were investing in it, myself as well, and then they were cooking the books. So they cut the dividend, share price down. I lost money on this quite a bit. I sold it straight away after the accounting fraud. And now Realty Income bought it. So it's still in my mind, right? I haven't forgotten about that. It seems to. So I start looking into the VRite again. It seems to that over the last 4 or 5 years, they resolved their legal issues that came out of it, and that the new CEO has been building up trust in the company again. So yeah, I guess that, you know, it's like Ahold. Ahold also did once fraud. Also Shell did once fraud. So it's really about what the next board does with it, and I'm giving them the benefit of the doubt. Let's say it like that.
Yeah.
Yeah, but having said that, then from an earnings point of view, I mean, they had an adjusted funds from operations of 86 cents, nicely covering the dividend again. Kept investing again, purchasing new properties, and also maybe interesting for the European investors. They are getting bigger and bigger in the UK. Another 400 million was invested in the UK. I don't know how the housing market is there, but it seemed for me when I think about UK and especially London or something like that, always sounds expensive. So that will be interesting. But what I found most interesting, what I pay attention to with Realty Income is really the occupancy rate. How many I said how much is rented out. And what I really liked about it is, and what I found really interesting is that I said the theater clients are growing again from 13% to 15% of people that are paying the bills. So it's still only like 1 out of 7, 1 out of 8. But this is also what you see in these numbers is a little bit the recovery in the economy as well, right? And the same
Yeah.
was with the health and fitness clients. That's really recovering nicely as well. Really impressive for me. So the numbers are getting again a little bit to pre-COVID levels, except for the theaters. So for me, it means that Realty Income, also with the merger, where they say it's 10% directly accredited to the funds from operations. Yeah, I think pretty solid, and they're well positioned for this year, I think.
Cool. I didn't. I've missed this one actually. So it was good that you mentioned the merger as well, because I did not know that. But there was just a solid company. I love them. They're dependable. They give me a dividend
Mm.
every month. I just want to say to the Goiro, sort out these
Yes.
investment trusts, because I can't buy any more, and I don't want to
Yeah.
buy them on my broker because I'll be mixing portfolios. So just sort it out for me.
Yeah. Yeah. So full disclosure, maybe I sold a put option this week on $60. I think expiring in July or something. No, in September. In September
Okay.
for $1.20 or something like that. So if it doesn't reach that, I get $120 for that. So also nice dividends. And EMF, if you want to know more about the VRite merger with Realty Income. Dapper Dividends Russ that we had last week on the show. He has a really good video about that. I'll put the link in the description as well. It's like a 10-minute video or something like that, but he explains it really well.
Perfect. I'll check it out. I have his show bookmarked. Just need to catch up on some some stuff this week.
Yeah. And then the last company that I wanted to personally pick out is Koninklijke DSM, the Dutch state mines. What I like about this company, I mentioned in one of the earlier shows, it's like BASF, but then they made quite a turnaround. So from a materials company, more like a pure play, it also transformed into more nutrition. And it's doing really well again. And nutrition is on fire again, 7% organic sales here year over year. But also the recovery in materials is really apparent. And we've spoken a little bit about inflation as well and such, and the input costs. Now, DSM is one of those companies that charges these input costs to the car manufacturers and such. So it's almost at the source, I would say, around this. Of course, it buys it from the mining companies and such as well, a lot of the materials or whatever it needs it from. But volumes were up 21%, and that just shows that the economy is really recovering at the moment if companies like DSM start to report this. So overall, for me, a very good quarter. They give trading updates, right? Not few full financial statements here, where their EBITDA is up again with 13%. And how is it? And their margin grew from 19% to 20%. So for me, very solid numbers this quarter. And I expect actually that they will over deliver this year if I see a little bit how the world is reopening. So
Yep.
issue is only this stock is always too expensive for me, and maybe I one time just need to make a conviction buy, like just because I think they're trading probably again around what is it, €150. Maybe I should just buy, I don't know, 4 shares just to so that it gets into my portfolio as such, because I like a lot about this company, really a lot.
Cool, nice. I think that's all the companies we have this week. Might move on to some listener questions actually, if that's okay.
Yeah, let's do.
So the first one is from you know who, Phil, and he asked us, "How are your portfolios doing? Is everything on track, or any adjustments changed planned?"
Yeah, everything is on track. My portfolio is doing. I mean, I don't know exactly, to be honest. I know what it was doing as per the 1st April after my quarterly summary. But I don't think that any company in my stock did something awkward. From the ones that I track, they are just muddling along. But yes, I am planning some adjustments. Maybe not so much in my portfolio as such, but in my desired portfolio. So I've got my allocation strategy with 40 companies, and I'm going to throw a few out that I don't believe in anymore, which I maybe not even had a position in.
Mm-hmm.
And that's mainly in the tier 3 and the tier 4 category. So I'm going to clean up a little bit, because every May I do a spring cleaning, and it's usually in those categories. And I still haven't made up my mind on ExxonMobil. So I still have some work to do there. I'm delaying it all the time, my homework there. So yes.
Yeah,
What about you?
my portfolio has been changing massively this year, and we spoke about it on our last update, where I've changed from nearly 90 or 80% to US to European to 50-50, and it's nearly overtaken more so with European at the moment. So I've kind of weeded out most of the companies I don't want anymore, and I'm happy where it is. I actually, for the first time, I did a dividend capture on BASF this month. So I sold them. I know they're doing really well. I bought actually 100 shares of them, collected a dividend, put in an order to sell at the same price, and it hit within 2 days. So it was like free dividends. It's the first time I've ever done it. It worked out pretty well, but other than
That's
that,
really interesting.
yeah, it's the first time I've done that. I probably won't make a habit of it, but I think some European companies, they pay, don't they? They pay yearly. So I looking at it, if you're only going to get one dividend, maybe just try and collect the dividend and buy and sell in between, and it worked out okay.
Yeah, I don't know if today is the ex-dividend date for Danone or on Monday. You might want to check it out. Otherwise, you could try it once again.
Oh, I have their own anyway, so
Yeah,
I'm not buying or not selling them. But I was going to try and do it maybe with another European company.
yeah.
But we'll see.
That's very interesting. Thanks for sharing.
I'll let you know next time beforehand, so we can see in real time how it does.
Yeah, cool. Then the next question is from Centrino, and he is asking, "What are buybacks? Are they good news or bad news for investors?"
Yeah, buybacks are. I mean, companies have a number of shares outstanding, which counts towards their market capitalization. When they have excess cash, they buy back shares. It reduces the count of that, reduce their share count, and maybe increases their earnings per share and all these other metrics that we go by. Are they good for investors? That depends. Usually, yes. A rule of thumb it is, but you want a company buying back shares when they're cheap and not when they're expensive, because why I'd rather them give the money back to me as dividends rather than buy shares when they're expensive. But pretty much
Yeah.
there's not much else to it, really.
Yeah, I have the same, and I can give some examples of companies that did it really well so far. Versus Ahold is buying back shares, I think, for 1 billion per year on a, what
Mhm.
is the market cap of 25 billion. So that's 4%, and they do it almost entirely out of cash flows. Yeah, that's what I love.
Yeah.
So they have a good enough balance sheet. They pay their dividends first, and they're still able to pay this out of the cash flow. So that's what I really love. Microsoft as well, doing buybacks all out of the cash flow. And then the question is, of course, is it overvalued? For me, that question is most relevant if they are borrowing money to do buybacks, and that's when I don't like it.
Yeah.
If they borrow money to buy undervalued shares, then I'm actually still okay with it to some extent, as long as it doesn't blow up the debt ratios through it. Right, it still needs to stay in a healthy balance.
But
Yeah,
maybe give some bad examples. I know we beat down IBM a lot, but they've used this buying back shares as a way to prop up their earnings. So it looks like
yeah,
they're doing better than what they are. So if you just check the earnings per share number, it looks like it's increasing, but they're artificially increasing this by buying back the shares. The revenue is declining. So they're using that as a kind of a smoke screen to
yeah.
portray they're doing better than what they are. So
And their balance sheet has been deteriorating over the years from
yeah,
that point of view.
yeah.
Yeah,
So I mean, generally it is good, but it can be bad, or it can be used to smoke screen
yeah,
declining revenues and balance sheets. So just keep an eye out.
yeah. And then our friend Tiago Dias, he asked whether you have gotten your 2020 tax return yet, and if so, what did you invest it on?
Tax return. We normally pay tax. We don't get tax back. But I mentioned this off air too. Ireland actually has a progressive system here where we pay. Everything is in real time. So uh, I think it was maybe last year, or the year before, they brought in this system. So in theory, there's no need to be getting tax back or anything like that. Everything is in real time. Employers have to file it every week. So I got nothing back this year, I'm afraid.
Yeah, I think it depends on the country. When I wasn't living in Netherlands, I often got money back in the end of the year because you pay kind of a little bit upfront, and then with the deductions, you get money back. In Poland, I need to pay every year additional. So it's for me rather I need to put some cash aside. So I'm investing in the local society here with my tax returns.
Cool. So the next couple of questions are from Arose Detum. I don't know how to pronounce that, sorry. And he asked us, what is your worst performing stock?
So I have no clue what it is this year because I don't look at that. I don't even track it in my portfolio. So all over time, from the stocks I have still in my portfolio, it's General Electric.
Okay, mine is Waco. Out of my current portfolio, I'm just checking there. It is AT&T, which is down 2% this year. So I mean, I'm not too bothered by that. It's not something I track a whole lot. I've kind of got rid, as I say, got rid of most of the weeds. So we've got a nicely performing portfolio this year. His second question was, did you sell anything that went up greater than 200%? And after you sold it, and if yes, how bad does it feel?
Yes, I sold McDonald's. So I remember buying, I don't know when it was, 2014, one of my first shares ever. I think I bought like, what was it, 40 shares of McDonald's at the time for $90. And then I sold it for $120 because I did an analysis, and for me it was heavily overvalued at the time. And well, we know where it is now. What I missed also at the time, they had the CEO, not yet the CEO that they just sent away again. I think he did stuff that you shouldn't do. Let's say like that with women, I believe, are having relationships. But they then, because there was this whole feeling here, and I saw it around me, all the parents were saying our kids cannot go to McDonald's, it's unhealthy. That was this whole wave for a year. And you saw the numbers as well. I thought, like, okay, McDonald's is dying. And then they came with new menu. A year later, all the parents were forgotten. They were saying, like, how can you not go with your kids to celebrate your birthday at McDonald's? That's what McDonald's is about. Yeah, so everyone forgotten about the health movement. So I think that and then you saw the stock going up and up and up, and as well after that. So how bad does that feel? Not bad, because I know that I'm invested the money elsewhere, and it has also been growing with the bull market. So that's the fun fact, right? I also sold Disney yesterday, or last year in May or April after the dividend cut. I bought Chubb for dividends, and Chubb also went to, what is it, 160, 170. So I usually don't have, well, this doesn't happen often, but I don't have these feelings a lot.
Yeah, Disney came to my mind when I saw this question, and then I remembered Tanger outlets, and I bought them. I can't remember if I bought them at 10 or 11. I end up selling them at $5 or $6, and then they shoot up to $18. And how did it feel? I'd have to beep out this section if I was to if I was to say how it felt. But it doesn't happen, hasn't happened too often. I'm not too sour about Disney. My thesis changed. My only sour thing with Tanger was that I bought them. I should have held them. I had no reason to sell them. I know they suspended the dividend, but they were always going to reinstate that. So I should have kind of held on. But doesn't feel great, no. But what can you do?
Yeah. Well, and then his last question to us was like, did you ever buy a stock just because of fear of missing out and sold it shortly after?
No, I don't think so.
So I did it. I just don't remember anymore which stock. It was really at the start, the first year of my journey, that I bought something, and I thought like a day later, like, what the fuck did I buy? I had no clue. And then I got afraid that, oh, it could go down again. So I quickly sold it. I think I think this happens probably to a lot of investors, specifically in the beginning when you don't really know your strategy yet. Then you're often in a situation that you're following others, and this can happen actually to us, that others are following us and they buy something. But please don't buy because we buy it or something like that. Or when we do an analysis, please still do your own analysis. But yeah, no, it happened to me. I really remember that really vividly. I just don't remember which company.
Yeah, it can happen to most investors. I know I get tweets or emails in my inbox almost daily now. It's starting to become a habit. And people asking me, this company, and they've grown this much. Should I buy them? And I'm not never going to give anyone advice. I never will. I'll tell them what I think, what I would do. But certainly, I certainly don't follow others, and I don't expect others to follow me, because everybody has their own opinion and conviction.
Yeah, definitely.
So I think it's Stubads has asked our perspective on the impact of inflation on our holdings.
Yeah, I mean, I did a video on that, Stubads, 2 weeks ago. So I'll put in the description of this podcast, and I spoke about inflation. So um, I think that most of the companies in my portfolio will be able to pass on the inflation to the consumer by increasing the prices, or to low or I said decrease the volume of the packages or something like that, and still selling it for the same price. So I think I feel pretty confident in that, because I went through my portfolio. There might be one or two companies that have a weak position in the supply chain, and I need to think about those still. But other than that, I think I feel totally fine on that, because when inflation is happening, actually being invested in the stock market is one of the best things you can do, because companies can pass on the inflation. Yeah, and if you get hyperinflation, at least companies can still sell their products then, because we still need food, as an example. So that's the good thing about this.
Cool. Yeah, I definitely recommend them check out that video. It's quite a good video. So we will post that link down below. Okay, so Kurt has asked our opinion on vandevelde.
Yeah, I don't know if he did this to tease us, because you pointed it out. We opened up the annual report, and damn, that's one of the nicest annual reports I have ever seen. So, I mean, everyone look at page 6, page 8. Very interesting stuff on there.
Yeah, I did not know a lot about this company before. I funny story. I was sitting here and opened up that report. My wife walks in with a cup of tea, and goes, "I thought you were recording a podcast. What are you doing?" I said, "I'm researching the stock," and I had to show her the question. It's quite funny, but you'll understand when you go to the report. You'll see why. I didn't know. My wife never heard of the company either, which was a bit worrying for me, because you'd imagine that that girls with no female underwear companies, but they've been around for a long time. I think 100 years from what I read. They have a dividend policy of paying out 40% of profit. They aim to increase this gradually over time. They have cut the dividend in the last 10 years, but I mean, we briefly looked at the balance sheet, didn't we? And it's rock solid. Like they're quite cash rich, quite
Yeah.
cash rich company. But I mean, I spent 10 minutes looking at them today, not really in depth analysis or financials, but certainly interesting. We mentioned risks with small cap. Dividend is always at risk, and you can see that at play here. But their stock price is taking a heavy beating. And maybe when we start to open back up, people are going to go on holidays, they're going to be buying underwear and swimsuits. Maybe we'll start to see their sales pick back up, and their share price might follow with that.
Yeah, and it was for me clear that this is not a digital business, because they wrote in their annual report that due to COVID-19 and the online adoption, that they felt it was time for a bit of a remake of their website. If I hear this, it's telling me that this is an old style managed business, probably depending on a lot of foot traffic, and not a digital first business. So that's probably also one of the risks here, and why it's so impacted by COVID-19. It's probably not in their DNA to be an online channel.
Yeah, it looks like they're a big brand and they must have brand power, but maybe it's all about the experience of going in and trying on these types of clothes. I don't know, but maybe that's where that comes in.
Cool. Then Brady has a question. He's asking, actually, I guess it is about me, because there was a question where I answered about 3 stocks that I would like to own. And I remember one was Europe, one was US, and one from elsewhere. I mentioned Alibaba. And he's asking if I'm buying the dip, or do I see more value elsewhere? So I'm not buying really the dip, because it's now 225. I bought at 230. It's supposed to be a small position. If it would touch 200, I would probably buy some more, maybe 5 shares or something like that. It's not so much about seeing value elsewhere. It's more like it's a small position. I can average down on the news, but I don't feel like buying at the same level I bought before. It's adds no value for me from that point of view.
Yeah, cool. And the last question of the day goes to Peter Sprout. And he asks us, what do you think about the Unilever tea business that is likely to be split off via listing? Do you think this is a good idea, or do you think they should split their entire food division?
Yeah, this is a really interesting question about Unilever, because it's clear that the company is becoming more and more like a personal care company and trying to become a beauty company. I think that's a higher margin business that Unilever is also seeing. But then it will become a competitor of L'Oreal and such. I have a feeling like they should stick a bit to food and these kinds of things as well, because it's what their DNA is, right? And I don't see the need to transform totally into a home and personal care division. I don't see the need like what Philips did from from a television production company or something like that, transforming fully into healthcare. I don't think there's a need for that for Unilever. So I'm a bit of a historian when I analyze companies. So also letting the tea business go always gives me this feeling. But I understand it, of course, because the tea business is just not a high enough margin business for them, so to say. So yeah, I support it. I think they have a good management. I don't feel like they should split off the entire food division, just because of my sentiment. And it's probably not the wisest one from an investor point of view, but I like Unilever, the diversification as it is. I feel that the food business is really stable. Also, in these times, people will need food. If it goes to personal care, I'm wondering like what that would do to the to the resilience of the company, as an example.
Yeah. Yeah, I don't think they should split their entire food division. I don't see why you would do that. When I think of Unilever, I think of some of those food brands straight away, not so much the home and personal care. Maybe it makes business sense for the numbers guys, but I don't know. I don't see the need to do it really. Okay. That's the last question. Thanks very much, guys. As always, enjoy those questions, and we love teasing out some of these answers. So again, keep them coming. Um, Thanks for listening, and as always, thanks to European DJ for his time on a Friday.
Thank you as well. And yeah, everyone a great weekend then. See you again.
See you later.